Bob Iaccino, welcome back. It's really cool to have you here. Thank you for coming again.
Good to be here again.
So we did an interview almost a year ago, and you talked about the glut in the supply of crude oil and how that would send prices down lower. It seems like that's what has happened, and I just want to know your thoughts on that.
Yeah, it definitely has, obviously. I mean, you've been looking at crude prices in the last year. The main sell-off, the real steep sell-off, started in about June or July last year. Really accelerated through August, and it's just been kind of an orderly drift since then. I think we're down at about $30.50 today, and that's massive. I mean, that's a 77% fall. There's no real change in the situation except that now, from the time we talked last year till today, you're actually seeing somewhat of a global economic slowdown. Mm-hmm. You're even seeing talk of potential recession in the U.S., which I'm not really buying into at this point, but what you can buy into is that some of the economic growth we had the first industrial-led recovery since the 60s, and it was led by crude and by places like Texas and Montana and Nebraska and those states that did a lot of that drilling that made the U.S. the third largest crude producer in the world, which is crazy if you think about where we were 20 years ago. So the situation of oversupply as of today hasn't changed, and potentially you have slowing demand. So it's a really crowded short trading right now, and it's going to snap back in a very ugly way at some point, but that's not really in the next 3 to 6 months at all.
And so I've heard things like, I think in The Economist I saw something like $18 oil and maybe a 2017 bounce back. Those are just random figures that we're hearing in the news.
Some of the big banks in the U.S. are calling for $20. I have a target, and we're not far off it, of about $26.25 for crude. Now, we're speaking at an interesting time because the S&P just had what I would consider, from a technical standpoint, a capitulation low. Now, that doesn't mean it's not going to go lower, but it means it's probably going to go sideways, and there's going to be some decent up days. Oil hasn't had that yet. Oil, again, in the last, say from $60 to $30, it's been fairly orderly. And I'm starting to get calls from like friends and family now who aren't in our industry saying, you know, how do I buy oil? I really want to buy oil. I don't think it can go any lower. And that's when you get nervous. If you look at a historical chart of crude oil, it really it spent a lot of time at about $25 30 years ago. And that's pretty much the average price for crude. It's about $30. So when you look at it 30,000 feet above, we're not that low historically. Okay? Demand was less than, supply was plenty, and that's where we sat. So what you're looking at now is a situation where the demand factor comes in, and I think that capitulation low that has to happen in crude for it to bottom happens somewhere in that $20 range. But if I were to have a short trade on, which I don't anymore, the place where I would start to get out of that is about $26.25, $26.50. That's what I do with targets. It doesn't mean it's not going lower. It's just the place I expect it to get to.
And what are going to be some of the main supply factors as usual? Is it going to be keep watching OPEC and keep watching the
Well, okay, it's interesting. So we had an industrial recovery in the U.S. We might be heading into an industrial recession. That doesn't mean an overall economic recession, because lower fuel prices is good for a lot of industries and it's good for the consumer. But there's an interesting thing where the state of Texas didn't have a recession while the rest of the country did in 2007, 2008. The state of Texas never went negative GDP. Texas is suffering now, suffering dramatically because of the lower crude prices. So they could potentially lead the industrial side of the U.S. economy into a recession. Having said that, our industrial sector isn't that big anymore. So I don't think it's enough to drag the rest of the economy, especially when you talk about the upside of lower energy prices. So from a supply standpoint, even with lower prices, as of last week, we've only cut about 200,000 barrels a day in U.S. production. Now, a lot of that has to do with when the technology involved in fracking. Those wells, they're drilled, you have to keep pumping them, you can't stop, and they dry up pretty quickly. So the supply from the U.S. is now the marginal producer. Okay, we're the ones who fluctuate. Whereas you look back at data on Saudi Arabia, for example, they haven't moved much at all. It's about 500,000 barrels a day up or down, since about 2012. So that tells you they don't have a lot of capacity to go up, because when they wanted prices to go down, all they did was they didn't cut. They didn't really increase production much. Whereas the US, when some of these shale and fracking wells dry up, they're not going to be replaced. So that's when you're going to see supply tightening. I think that the Federal Reserve banks of the world are hoping that demand picks up at that point, but I don't necessarily think they're going to sync up like that.
Well, I think that's informative, and I really want to thank you for your time.
Anytime. Glad
All
to be
right.
here.
Thanks for joining us.